Hello, and welcome to On Point, a podcast by Oak Street Funding, where we sit with industry leaders to hear their stories and share their insights. I'm your host, Kim Grothwell with Oak Street Funding. Today, I'm joined by John Henry, founder and CEO of DryStone Capital. For 24 years, he's proudly led DryStone. He is an innovator in program business, reinsurance, and all that is DryStone. With that said, John, tell me about yourself and your path to where you are today.
Well, Tim, I'm an entrepreneur, and I've started and had run three companies. The first was agricultural biotech company. The second one was environmental investment bank, and the third one is DryStone Capital, which is a property casualty reinsurer.
About DryStone, and really specifically, why DryStone, and what made you decide to start DryStone? What's your vision?
DryStone started out as an internet company. We were called eLaw Forum, which suggests that we were an internet company.com. My original vision was to use the internet to bring competitive sourcing to the delivery of legal services for corporations. And as you know, the competitive sourcing had swept through low value goods and high value goods and low value services, but it hadn't gotten up into high value services like the practice of law in corporate America. So, and I think the billable hour is the root of all evil. And I thought I could my vision was to replace the seller's market with a buyer's market.
Oh, that sounds like you started with on the same starting line with the likes of Bezos and Zuckerberg and that crew. That's what.
Exactly right. Yeah, we were all on the same starting line when the gun went off on the internet boom, and Amazon and Facebook and Google, created huge internet consumer demand for products, social interaction, and information search. And my partner, Cloyd Laporte, joined me several years after I started the company. And we saved more than approximately $500 million in the Fortune 500 self-insured market. But after years of doing this, we failed to create a sustainable and reliable demand among our Fortune 500 clients for competitively priced legal services.
Yeah, and why didn't the corporation see your value?
Well, the legal profession has a lot of prejudice and a lot of prejudice against competition. And that prejudice proved to be too strong to overcome. The incentives in corporations aren't aligned for cost management, and the legal departments are big bureaucracies.
So at that point, what did you and Cloyd decide to do about that?
Well, we migrated our business model from the self-insured Fortune 500 legal market to more litigation-intensive insurance market. And once again, we were wildly successful in reducing litigation costs. This time it's discontinued operations in insurance. It's called runoff. But our large insurance clients were also like the self-insured market. They were more interested in controlling the outcome than in cost savings.
So were you thinking you were going to fail again? Or what happened?
Yeah, we were headed straight to go over a cliff, and nothing like a hanging to focus the mind.
So what happened to turn things around? And really, what does that mean?
Well, we finally cracked the code. We simultaneously migrated from what I call dead business to live business. That means from runoff, discontinued operations to underwriting. And we transformed ourselves, transitioned from being an agent to a principal at the same time.
And how fast did, and because of that, how fast did DryStone grow?
Well, from a dead standstill in December uh, uh, 2019 to December last year, 4 years, we grew to over 400 million in premium, in program premium, with half a dozen employees.
Wow. I have to say, I remember when I first met with you and you and Cloyd and met you folks. And I want to say that was towards the end of 2020. And it was just over that hump. So what that is just amazing, an amazing story of growth. And you got a lot of persistence. I'll give you that.
Well, thank you. It took a lot of persistence. Bud and I did live through the valley of the shadow of death, but we never lost faith that we could create a lot of savings. We could generate a huge amount of money in terms of cost savings, doing things the way we do it, which was differently. We kept just changing the business model at least a dozen times. It depends on how thinly you want to slice it, but for 2 decades until we finally figure out how to create a self-sustaining business that would guarantee us repeat sales.
Mhm. Well, I was just going to ask, how did you and how do you continue to differentiate yourself, in this industry where that is a difficult thing to do in this industry.
Yeah, well, corporations are different than individuals. Those other, the ones that were really successful, the internet, were based on the consumer. Corporations are a different animal. Once we became the buyer, we were able to control the sales channel for the first time, and we were able to fire our customers, and we took our business took off like a rocket when we brought it inside. We became the consumer of our own services. Well, we differentiate ourselves. We pride ourselves in being the most invisible company in the most invisible industry. Insurance is invisible, but if we didn't have it, the whole economy stopped. And we're very invisible. The smartest people in the industry have been on the investment side. Warren Buffett, Exhibit A. Warren Buffett sells insurance so that he can use the float to finance his hot hand in the stock market. And DryStone is on the other, not on the investment side, but we're on the meat and potato side of the insurance industry, which is claim settlement. And we have a unique approach, which is more efficient to selling claims than the industry. And so much so that other reinsurers in the syndicate ask us to manage the claims for them. So we're not in any book in terms of quota share in any program business where we're not managing the claims for everyone. We've got a new CFO, and then I've got another young 33-year-old guy who could have been CFO easily, but I made him AI director. And so all the AI stuff is numbers. So accounting background, I think, is the right background for AI director. And so we're just rivers of data and cash, right? Which is data. And we're going to automate the whole company. So I think we can stay at 8 employees and scale to $1 billion many times without any more employees. I think we have the opportunity to have 24/7 workers that we don't have to pay electrons. And so we can take a lot of headcount on the law firm side, and then on the accounting side, we can scale without more people. And all the data flows in and out, and the manipulation all can be automated. And when the law firms spent 80-90% of their time on an Easter egg hunt trying to get all the information, we can have all that populated. Like, if you're driving a plane or a car, they'll have it all populated, so they don't have to go, waste a lot of time looking for information. So I'm very excited about the AI. I think that's could double or triple our profitability.
Does the name DryStone factor into everything that you just built? Understanding.
Yeah, when I married my wife, I never talked about stone. I didn't have any lithic dry, but when I hit 50, I was playing golf and I was on the backswing, and my identity went out of my golf game into the landscape, and I got, really obsessed by stone. So I've been, for the last 25 years, I've been really into stone, and, it just came out of nowhere. But so I named the company after my hobby, DryStone, because DryStone means not wet, no mortar. Means you're not using mortar. Mortar is not dry.
You're building something that it has to fit so well together on its own without stuff in it to hold it. Being the more so that's why I said, and I researched that when I first met you folks. I'm going DryStone, why? And then I figured that out. And how do you use debt to finance such rapid growth?
How do we use the capital?
Mm.
Yeah. Well, first of all, we probably ought to distinguish between different types of capital, right? There's equity capital and debt capital, and the industry was built on equity capital. And so, wanting to do things differently, we decided to build it on debt capital. But we looked at equity capital, and we decided not to go the route of doing private equity, because that would have meant giving up control to outside investors who wouldn't understand our business nearly as well as us. We just spent too much blood and sweat to get here to give up control to outsiders. So the debt route really allowed us, was very attractive for that reason. And we wanted to be, we wanted to have the distinction of being the first insurance company to use debt exclusively to finance growth.
And what made you decide to work with Oak Street, to choose Oak Street as that partner?
Well, because of your insurance expertise, Oak Street understood what our numbers meant, right? A lot of banks don't specialize in insurance. They have no idea what the numbers mean, and Oak Street did. And we like the quality of people. We enjoyed working with you and Rob Roach, and you guys took the time to understand our business in great depth, not superficially. And because we're what my friends who are marketing experts use the phrase "purple cow." We're a purple cow, meaning we're unique. That meant a major commitment on your part and our part to reach that level of understanding, and a lot of appreciation, I think, flowed from that. Yeah, the strong relationship that we developed over 3 years really paid off in the latter part of 2024. Well, let me start earlier. The first thing we did was we cleaned up our past in order to, do our future. And so we used the initial credit lines for stock buybacks to buy out our minority shareholders. But Floyd and I are, the two shareholders of the company. And but then in the latter part of that wasn't that went very smoothly, but that wasn't very dramatic. But in the end of 2024, there was a lot of time sensitivity to completing additional debt facilities. Our teams, the Oak Street team and the DryStone team, worked really closely together with a high level of efficiency in a very short time. It almost felt like a symphony. It was at a crescendo like bolero at the end. So anyway, as you know, our close relationship with you and Rob, allowed us to give us everything you needed to gain senior management approval in a timely fashion.
It was like a symphony, and it was and being year end, it helped that stress level as well, because things need to get done by the end of the year. So it was memorable. I would give you that. But
Oh, absolutely. The hands-on approach, the strong professionalism, the track record are all of, tremendous, great value to us. And we're eager to open the next phase of our relationship. Here in 2025, we're going to begin shortly, actively discussing our plan, how we're going to double our business in the next 3 years. And we expect to reach $1 billion in program premium by December 28th. That's our goal.
With that, is there anything else you'd like to add about our relationship, the banking and the full banking relationship you have with not only Oak Street but with our parent company, First Financial Bank? It's just one. It's really a holistic um, enterprise relationship that you've been able to capture. And any thoughts on that, or any closing thoughts?
I think Oak Street and First Financial are and look like what a great bank should be, as opposed, by contrast, to the too big to fail banks, who are more interested in gambling in the derivatives market and then financing the growth companies that are going to be the backbone of our economy. So anyway, you guys, it's a team effort now of Oak Street and First Financial, the whole thing, and us to be our growth partners. And we plan on doing this for a long time. So I'm not. It's going to be a long-term relationship.
I hope so. Well, John, thank you so much for your time today, and again, thank you for being a great partner.
Thank you.
Appreciate it. Thank you.
Thank you, Tim. Bye.